Okay, well, it looks like we are 1 o'clock Central Time. That would be 2 o'clock East Coast Time, 3 and wait, other way. And I'm not,
Other way.
really I'm not really ever good at that. So 2 o'clock y'all's time. So we are ready to go, East Coast Time. This is TMC Connect. Thank you all so much for being here today. We appreciate it. As everybody filters in, please know that you are coming into the meeting as a webinar and are on mute. But we do want this to be interactive, so please feel free to put your questions in the chat or in the Q&A, and I will address those to our panelists as we go along. We have with us today Lori Pinto, who is the SVP at Sinlar, and Mike Wilkinson, who is VP at Dover Mule Mortgage. And our topic today is trends driving subservicing adoption and what you need to consider. So thank you both so much for being here. Servicing definitely is top of mind as the pandemic rages on, and we are so thankful that you are here to share your expertise with the TMC network. And with that, we can get started. Oh, and I can introduce myself, I guess. I'm Tony Bramley, and I'm the Business Development Coordinator here at the Mortgage Collaborative. So awesome. Well, with the trends driving subservicing adoption, I think one of the things that we are interested in is what does 2021 look like? Mike, what do you think?
Hey, Tony, thanks for having me. First off, it's a pleasure to be here and connect with some of the TMC family. Certainly miss seeing everyone in person and being part of the conferences. So it's great to be able to jump on a webinar here. And Lori, thank you as well. It's a pleasure to share this with you as well. As far as 2021 goes, I would say, right, everybody is well aware that 2020 was very unique. And if mortgage servicing wasn't difficult or challenging enough, there's been several more additions to the hurdles that we all have to overcome as we talk about servicing and subservicing. And there's a lot of unknown out there based on what's transpired with the pandemic, right? The extensions of the foreclosure moratorium, what's going on with forbearances, and ultimately when those forbearances that need to turn into true loss mitigation and workouts, how's that going to play out and what's going to happen? Even the changes with the 2022 talk about the cash window limits, right? So there's a lot of unknown going on, and it's hard to predict how all this is going to shake out, especially given the new administration and potential changes to some of what's been going on thus far. One thing I think that's safe to say in 2021 is that more of the same in regards to the adoption of subservicing specifically. I know Sinlar and Dover Mule, we've both been focused on mortgage subservicing for a very long time and have been around since the very beginning of mortgage subservicing. And if you think about it, somewhere around late 80s, early 90s, basically none of the loans in the US were subserviced. And there has been a giant move that's been persistent over the last 30 years, driving penetration of subservicing. If you just look at some of the current stats today, I mentioned 30 years ago, no loans subserviced. Right now, there's about $3.3 trillion of mortgage debt in the US that's subserviced. So total, there's only 10 trillion of residential debt according to the Fed. So we're looking at over a 30% adoption rate of mortgage subservicing over 30 years. And I think if you look at the year by year breakdown, right, it grows steadily every year, and then it accelerates in times of distress. After the financial crisis, there was a big spike in the adoption of subservicing. And given what's going on during the pandemic, I think once again there's been a real rush, big move to adopt subservicing as opposed to servicing loans in-house. So that 33% is relevant, and if you actually think about taking away the largest servicers, the Wells and the Chases of the world, I think you're looking at 50 to 60% of the eligible mortgages in the US that are currently subserviced. So I think that, as far as the trend, I think that trend is going to continue. It continues to get more difficult to service loans, right? Even people like Cenlar and ourselves that have large scale, right? There's no shortage of challenges and difficulties in doing this. It's a very nuanced function. And I think the trend is going to be more of the same though.
Yeah, and I would agree. I think that people that were afraid in the past to look at subservicing because maybe you won't give the care to my customer, my borrower, my member that I gave, is kind of going by the wayside. Not that we don't give the same service, but it's the knowing of the customer, borrower, member relationship that maybe is a little bit different. But they realize the economies of what we bring to the table. The integrations with vendors. I mean, today, living in the world that we're living in, I mean, just what's happening with the snow in this week. Tony, a good example of you living in Dallas. The environment that we're living in is affected. And so who do we have connections with that other entities that are servicing their own portfolios may not? So those small to mid-size servicers can't just reach out and pick up the phone and call a First American, a CoreLogic, whoever it is out there and say, hey, can you help me with this and expand your bandwidth here? They just don't have that that level of expertise. So I think, or that level of relationship that we as subservicers provide. So I think we provide more, Tom, to your point, in the market as a level of acceptance, because we can go in so many other different directions as well.
Yeah. Well, and speaking of the trends, I mean, Lori, what do you think are driving the trends to look at subservicing?
So I think the biggest number one is compliance. I think that, Mike mentioned the change in administration, the new, more forward-looking, like it was during the Obama administration, with the CFPB focus on what's not being done to protect the consumers. And not that we're doing everything that we can, but in a changing environment where the rules and the regulations are getting thrown on you on a day-by-day basis, and you have to make them in place immediately, there's very little room for error. And so the focus from a compliance perspective, interpreting all those guidelines, and again, reaching out to partners where you've got a relationship with the GSEs, with maybe the Housing Policy Conference, with a bunch of different entities, with TMC, having that kind of relationship with folks like that can help you guide and get to where the best decisions and where the common group is making a decision on the best way to manage a process, I think is the bigger overvalue of subservicing. You get the benefit of the knowledge that folks like Dovamil and Cenlar can do because we have so many connections out there. So I really think compliance probably drives a big piece of it. And then, Mike talked about just the change in the ownership of the MSRs, moving from banks to non-banks. As those entities have grown, they're focused on originations. And I think Dovamil and Cenlar happen to be different compared to some other subservicers that also do originations. All we do is service loans, and the originators, all they do is originate loans. So it's a good complement so that they can focus on the origination side of the business, really focus on making it digital, making it easier for the consumer to close a loan, or we can focus on what we do well. And when you connect two that are spending all their energies on just what they do well, I think you get a much better solution. So I think that's another thing that's driving subservicing. And then I think just technology, integration with systems. I mentioned vendors. Pushing through technology is not easy. And in a small shop, even if you're servicing 10,000 loans, I know when I started doing this a very long time ago, getting a 10,000 loan portfolio was like Yahtzee. You hit the big time. Like a 10,000 loan portfolio was huge. And now 10,000 is kind of blasé. I mean, some of our mortgage banking clients that are part of the collaborative have grown their portfolios from 1,000, 2,500 loans to 10, 15, 20,000 loans because of the interest rate environment. So that I think has driven it as well. And they've been able to take advantage of this. Look at all of them and how well they've done this year as a result of having a subservicing partner like Cenlar or Dovamil. I was able to rely on you to do the work I was able to do what I did well, which was originate loans. I was able to retain servicing. And now I've created this like giant golden nugget that's going to be more valuable than anything in the market when the market turns to be able to go sell it. So I think people think about it that way. I think that's a big direction for the non-banks to be focused on. And then I think the last thing I would focus on, Tony, is just the knowledge. The GSEs require you to have a servicing background.
Mhm.
So, in smaller shops, community banks, credit unions, even some mortgage banking shops that think I want to do it all, they have people that have grown up in the business and have been around like myself for a long time. When someone like me leaves the servicing organization, and believe me, at Sendler, that's not my level of importance. But when you leave an organization like that, you leave a shop high and dry to move on with servicing. And so it's like, well, what can I do? Where can I go? Where can I get that comfort that I'm going to be able to follow that? And all the eyes that we're looking at, all the different touch points within the organization, whether it was from origination and post-closing and how it affects my business, I can depend on the subservicer to do that. So I think there's a lot of different moving parts. The pandemic just happens to add another piece to that. Even just the resources and having people available to work remotely. Folks like Sendler and Domobile were able to pick up, move remotely and get it done where it was probably harder for some of the small operations. So the timing of it just seems to keep falling in place.
Right, I would agree.
Yeah.
What about you, Mike?
Yeah, I completely agree with everything Lori said. And then I think to highlight a couple of points that she previously made, one was that fear of losing that relationship or losing touch with the member or the borrower. And as the consumers expect more from their technology and how they integrate or how they interact with their financial institutions, the subservicing industry has come a long way in being able to build out the tools that borrowers expect today. So they might not be able to pick up the phone and speak on a first name basis to that borrower or that member. However, the subservicers now are able to offer integrations with online banking platforms or standalone websites with a lot of functionality that is comparable with other modern financial institution experiences today. So what they might lose a little bit of that touch point, they gain a lot in feature and functionality that the borrowers will be able to do. And then the only other point I would add is, as we learned last spring, when there was some serious disruption in the market and those service release premiums went away, I think a lot of people who were kind of used to hitting the bid on selling everything released realized that they needed a backup plan and they needed a full array of options to protect their business and protect their economic interests in future times of distress. So I think that's one other key point to why so many people are interested in subservicing this year, and certainly is the impetus behind a lot of the conversations that I have on a daily basis.
Yeah, I think maybe just to expand on that, just one little piece is that, when you grow a servicing operation, you grow it for a size of a portfolio. It's a loans per person to service. And with the size and capacity we have, and the folks at Domobile, you have the flexibility to shrink it and sell it. And so you park your loans, like Mike said, you grow it with the environment and the environment changes and I release it. There may be different pricing schematics that both of us have, but you have it. You don't leave the people in the servicing shop when you have a 10,000 loan portfolio and then you decide to sell it and you're down to 1,500. What do I do with those other 8 people? With us, we give you that flexibility. So you really do get that. And I think in this past year, the non-bank entities have really been able to see that I've got this unbelievable opportunity to refinance and do purchase market originations and grow, and I've got someone that I can depend on. So I think, again, I think it's just a perfect storm of a lot of things going on.
Yeah, scalability, technology, just being able to focus on your core best practices. I think that definitely is what subservicing allows the TMC network as well as other lenders to do, for sure. Absolutely agree with that. Mike, what about if you are new to servicing or a subservicing relationship? You know, what is important to focus on being new to that situation?
Yeah, great question, actually. And I certainly have gained a lot of experience this year in talking to originators that haven't serviced in the past, that are exploring it. And I guess the first thing that comes to mind is there's a lot more to it than I think what people originally think, right? They say, okay, we'll retain servicing, we'll hire a subservicer, and off we go. And there's a lot more to it than that. Yeah, exactly. Exactly.
No, it's more like this.
Yeah, exactly.
Right.
But there's more to it than people realize immediately. So, you know, as I said, a lot of my conversations this year have been with independent mortgage bankers that are looking to retain servicing for the first time. So kind of going through those growing pains and helping them understand, you know, certainly I'm not a consultant. There's a lot of experts around that can provide great advice on how to set up servicing. But my observations as a sales guy for a subservicer that's having these conversations, you know, there's some general requirements that are important, right? What are the financial implications of retaining servicing? How do advances work? How do you account for the MSR? How do you get MSR evaluations, right? They need to be marked, and who do you interact with and who do you go to get that kind of information? How does the execution with the GSEs work, right? So, and then also from a general perspective, right, you have to set up risk, compliance, doc custodian services, you know, strategies around borrower communications and things like that. So there's a lot of general information that you have to get your head around, and then find institutions to partner with to help perform all these services and functions. And then once all that's established, you know, we haven't even touched on the GSE applications and getting approved as a seller servicer with the GSEs. And there's a lot that goes along with those applications and what a new servicer has to comply with. You know, they get, you know, the GSEs provide detailed vendor selection guidelines, having to perform specific risk assessments, having, as Lori mentioned earlier, having to have in-house knowledge on staff about servicing with the GSEs and understanding servicing their loans, detailed structures on how to evaluate a potential subservicing partner. And then once you select a vendor, there's an ongoing obligation as well to being an approved seller servicer. So annual QC compliance, confirmation that your subservicer has a business continuity plan in case something happens. You're, as a master servicer,
like a
you have to, yeah,
right.
or power outages, and right. And then as a master servicer, you have to have your own BCP plan in case the subservicer disappears and goes away. What are you going to do? Extensive performance reviews, you know, looking at SLAs. You have to even be able to provide minutes of these performance reviews, and then, you know, a DR plan. So there's a long list of requirements that a first-time servicer has to meet, you know, both from a general business perspective and then also from that GSE seller servicer application. So, you know, surrounding yourself with good partners and a good team and going about it the right way, it's a wonderful function to bring in. And, you know, for all the reasons we've been talking about, it makes sense to engage with a subservicer as a new servicer. But there's a lot more to it, and certainly being able to have, you know, surround yourself with good partners is very key.
Yeah, and I think there's a good opportunity too for people in the market that have servicing experience when a department or a servicing operation is downsized to be that person. Because I've talked to folks like you have, you know, like independent mortgage bankers that'll say, well, I've got someone that took payments for us when the payments were getting shipped off to the correspondent and acted as the servicer. So can I use that person? No, that's not the right person. But if you're servicing in-house today, you can leverage the people that you have, or if you're looking to grow it, that person doesn't necessarily need to sit in your office all day. I've seen where a lot of independent mortgage bankers hire someone that visits their shop once a month, where they come out, they're there meeting the people, making sure they've got the direct oversight, but they can do the oversight remotely, because as a sub-servicer, we're making information available remotely so that they can self-serve and do their quality control checks that they need to do. So the more you make information available remotely, it allows more educated people in our business to do that oversight. So I think that's helpful, because there is a lot of work. It doesn't go away. You don't get to just push it away. Ginnie Mae's tough. Ginnie Mae wants you to make sure you understand. I mean, I think Ginnie Mae's probably, as everybody could probably concur, really wants to make sure that you understand the risk that goes along with owning, Ginnie Mae MSRs and the advancing responsibility. And they want you to participate in their annual audits to make sure that you understand why funds had to move, or your edits weren't clear, timely, and the impact that that has. They really want you not to pass that on to someone like a Cenlar or a Dova Mule while we do the function for you. Make sure that you understand it if one of us. So I think they all take it strictly, but I think Ginnie Mae the most, because the biggest risk is in those loans. There's the less amount of money that's put down on those types of products, and so the bigger amount of losses come out of those products. So they really have, especially Ginnie Mae, tightened its guidelines about what your requirement is for a sub-servicer. To the extent where Ginnie Mae was very vague and didn't talk about it, they've really changed the process in the last 18 months and gotten very detailed and very specific about what you need to do if you're going to really entertain Ginnie Mae servicing. And I would tell you that most clients that I see starting with subservicing really don't go down the path with Ginnie Mae until they get comfortable with a Fannie or a Federal Home Loan Bank product or a Freddie Mac. They get the ease, going to the cash window, selling that way, and then really work into the Ginnie Mae. Even if they're doing 1, 2, 3 loan pools, it takes them a while to get their FHA approval, get their underwriting approval, and then really move into that market, because it really is different. They really hold you to a much higher standard.
Representation is definitely an engaged partnership. Sounds like.
Right.
Sorry, Mike.
Yeah, no, I was just saying that's exact. I completely concur. That's a great point about Ginnie, to the point where they've even changed the eligibility requirements to approve new issuers to make it significantly more difficult going forward.
Just want to remind everybody, this is TMC Connect. I'm Tony Bramley, Business Development Coordinator. We've got Lori Pinto with Cenlar, as well as Mike Wilkinson here with Dova Mule, our fantastic preferred partners, sharing their insights on subservicing, the trends driving subservicing adoption, and what you need to consider. You guys are on mute, but please feel free to drop your questions in the chat in the Q&A, and we will definitely address those. So talking about the GSEs, how easy is it to work with the GSEs while you're using a subservicer?
Mike, you want me to take that? You want to?
Yeah, fire away, Lori, please.
Sure. So, I mean, it is a partnership. As a subservicer, the GSEs come to us and look at you as an overall portfolio, but they also look at the portfolios individually. So they report up to us about what we're servicing, but they report to you as an individual. And you want that, because you want to understand, you want to make sure the GSE understands that you do stand on your own, the value that you bring to that selling relationship and that partnership. So I would say that it is fairly easy to work with the subservicer. Mike talked early on, though, about getting approved. You have to go through your own approval process, no differently than if you were not subservicing. So I think the nuts and bolts of that is all the same. You have to set up your custodial accounts. You have to sign all the agreements. You have to be, prove that you've got a QA program on the origination and underwriting side, and that you've got a quality control program on the servicing side. You just need to engage your subservicer and make sure that once all those things are completed, that ongoing review continues. So I think not any more difficult, just a different path. You're just going down a different direction.
We've got, looks like James McQuaid has his hand raised, so I think Amy's going to unmute him. James, can you hear us?
I'm sorry, I hit that by accident.
Okay. Didn't mean to put you on the spot.
Good
Thank-
conversation, however.
Any
Thank you for
questions while
being
you're
here.
at it?
Quick, come up with something.
Yeah, right. Thanks, James. Well, Lori, what about, you were talking about working with the GSEs and selling. So what about selling in 2021? What are we looking at there?
So, it's interesting, and it would be interesting to hear from the group to see if they've got plans. We talked about what 2020, the pandemic, the interest rate environment has done for this business, given the capacity to the non-bank servicers. And so we're anticipating that when the market's right and the interest rates start to rise, the value of that MSR portfolio is going to explode, and our partners are going to want to start to sell. Is that going to happen now? Probably no, probably much later in 2021, unless something else happens that completely changes the interest rate environment, which Lord knows. Anything could happen. We could have frogs dropping from the sky tomorrow. We don't know what the next pandemic is going to be, but anticipating that probably later in the year. I mean, I have seen some portfolios out there for sale, but I think it's important to understand that there's work effort that goes along with that process. And I think any mortgage banker that has not, non-bank that has not regularly sold or has had a large enough portfolio to put up for sale in the recent past is used to doing co-issue sales or doing monthly sales, really needs to prepare themselves and their subservicing partners for the idea that they're getting ready to sell. The GSEs need a 60-day notification, and they need to approve that process of that transfer. So what you want to do and what your broker wants to do to take advantage of that market is not always aligned. There's probably some guidelines in your subservicing arrangements that you need to give notification to your subservicer. Not, again, that they can't do it, but they have to make sure that they've got capacity. So we're preparing for the fact that there's going to be some opening up and releasing of portfolios at the end of 2021 and into 2022. And I think that the servicers that have retained and grown that portfolio really need to spend some time thinking about a plan of attack of how they're going to manage that internally, because they have not had to gather 10,000 loan documents out of the vault or out of the custodian to transfer. They've sold in a co-issue, and as the documents come in, they get moved to the new custodian, or they're getting assigned at the time of the co-issue at closing. So it's a different process for a much larger scale, and I want people just to be cognizant of the flipping of a switch is not as easy as what they're doing or used to doing in the past. So I think that's something that those retaining servicing over the last 12 to 18 months are really going to have to pay attention to.
Yeah, well said. Totally agree. Just on the front end, there's a lot more to it than getting set up. On the other side, there's a lot more to it than just flipping a switch. I always like to say, right, the asset is much more liquid than the servicing transfer itself, right? You can put it out for bid and pick a partner and do that very quickly and easily. But when it comes time to actually do the work to transfer that servicing, there's a lot more to it, and it takes a lot longer than many realize. Yeah, completely agree.
Yeah, and I would think too, I mean, when you originate a loan, it's like anything. It's just like subservicing and you're transferring it. People get very quickly acclimated to who they're doing business with. So I originate with XY broker, they sell it to 123 mortgage banker, and it ends up at PennyMac, just making up a name. And somebody gets used to all of that. Well, now I originated with a mortgage banker down the street whose name I see in the shopping center, and they've retained my loan for the last 12, 18 months. And now I'm transferring. A loan officer has gotten really comfortable because that name carried with them, they're getting good referrals. And now 12, 18 months later, my loan's getting transferred. So that sense of comfort that a homeowner, member, borrower had previously is going to be shook up a little bit, because what happened? I got to stay with someone I knew. I picked the local mortgage banker. His kids go to school with my kids. And now I'm getting transferred. So there's going to be noise. So the mortgage banker is going to have to expect noise coming out of that that's retained that service, and we're like, why are all these people calling? Why is the call center blowing up? What's going on? It's the nature of the beast. We've seen it slowly happen as you're selling when you're originating, because you have that, but now it's happening all at once. And it's going to be the timing of it. Coordinating timing of this is going to be important. I mentioned, coordinating with your subservicer and the GSEs. But if everybody rushes to their subservicer at once, there may not be capacity at the subservicer. They may, whoever gets there first, I hate to say that, but I think whoever gets the first deal in is going to be probably the first to get their loans released. I mean, it's just the way it is. There's only so much capacity, and if everybody's trying to do it all at once, it's going to be problematic. So I think there's just going to be a change. Again, just another change. Watching loans shift from one place to the next. It's sure to happen.
Yeah. And so one question, it's talking about time. When is the right time to choose a sub-servicing partner for those folks that have been holding for 15, 18 months?
Well, Mike, I'll start, and then I think I'll ping it over to you.
Sure.
I think you have to have a strategy. I think you need to know what you want to be when you grow up. Do I want to retain servicing? Do I want to be, I always talk about subservicing. I've been doing this for a long time, and I've watched, I've worked in a bank environment, then owned a mortgage banker, then go to a non-mortgage banker, and you watch the love-hate relationship between the bank and the mortgage banker. They love you right now because you're making a lot of money, and then when the rates go up and you don't, they don't like carrying all the baggage that goes along with the origination side of things. But if you save MSRs for that rainy day, then you have that MSR, that natural hedge, as they say, to manage that. And so, managing that process and understanding what your philosophy is. Do you always want to have that natural hedge? Do you always want to have some MSR for the rainy day? Are you a part of a bank entity that can help fund your advances, and so they're okay owning servicing for a period of time? Or do you need to sell it off on a regular basis because that's what helps fund your next set of originations? So, Tony, I think you really need to understand who you want to be, and it can change. It can change with the market as long as you're identifying that. And then when you understand that, knowing that you've got a subservicer, like I said earlier, that can grow and expand with you, and you both go into that with the same expectations. If you sign up a partner as a subservicer, and I'm an operations person that became a business development person. But when you walk into that, if you walk into that situation knowing that they may never retain, but I'm going to sign them up, I'm okay with that. If you sign up with a partner that says, oh, we're retaining everything that we do, and they do it for a month, and then you end up with no business, you don't have a great relationship, and it may have not been priced the right way. So I think you really need to be honest with your subservicing partner and make the decision based on the model that you think you're going to drive. And maybe Cenlar and Dover aren't the right fit, but maybe there's someone else out there that's a better fit. And then maybe if you change your model, you pick another subservicer down the road. So I know I didn't give a direct answer, but I think there's a lot of variations on that. And Mike, I ask you to add there as well.
Yeah. That's the same place that I start thinking. Understand, going through that process up front and seeking advice of partners that have this expertise, and going through that process of thinking about your business model, thinking about the cash implications, how does it affect your balance sheet and all the various downstream effects that retaining servicing will have, and establishing a solid plan, just as you said, Lori, understanding who you want to be and why you're doing it and what it does to your business, and then modeling out ahead of time. If rates go up, what happens? What are we going to do? Not just financially, but operationally and strategically as well. If rates go down, what's our plan? And working through this in a very methodical and diligent process helps you be prepared for those situations in the future, so you're not left in a reactionary state of mind, that you're able to make decisions and change as the market changes, because of these plans that you set in place. And then having a subservicer, you know, we keep talking about it, is very important in that strategic flexibility, right? Having somebody like a Cenlar or Dovamil allows a lender to originate and retain any loan in any quantity in any state at any time, and be able to add quickly, sell everything quickly, and it just gives that strategic flexibility to execute on whatever the markets and the changing dynamics of our environment dictates.
For sure. I want to remind everybody, if you've got any questions, now would be the time to put them in the chat or the Q&A function for Lori and Mike. Also want to let you guys know that this is being recorded, so there will be a follow-up email with a link to the TMC YouTube so that you can go in and watch this again if you'd like. We will also be putting this on TMC's podcast as well. Don't see any questions, but I do want one last thing, key takeaways. Now I'm going to put your Swami hat on and get your crystal ball, and what do you think are the key takeaways for servicing, subservicing in 2021?
I'll start. Key takeaways, I think, are, right, servicing is great. Mortgage servicing is a great function. It's a great asset for many reasons, whether it's a financial asset or just a key relationship with a borrower, right? If you're a depository and you have this account and being able, you know, originating a loan and then selling off that servicing and allowing your client to interact with a different institution, right? It's contrary to what a lot, you know, especially credit unions, community banks that are all relationship driven. So having a subservicing partner is very important in that regard. And the second piece, I think, is, you know, if anybody learned anything today, I hope, right, there's more to it, and really thinking through all this and understanding what you're getting yourself into, and how you need to surround yourself with the right partners, and then communicating with those partners as to what you're trying to accomplish and why.
Communication, definitely.
Yeah, communication for sure.
I would just say keep your eyes open for what's going to happen. You can't overplan. If rates drop again, God forbid, we could go through another refi craze. I can't even imagine it, but I don't think anybody thought that we'd see how many we have over this stage. And I'm not forecasting a rate change by any means, but it's really be aware of what's going on and what your plans are. I mean, just plan for how you want to grow. You know, Mike mentioned about we can be anything for anybody, any place, any product. You know, so are you not looking at a certain product? Where can you expand your business model as you look that maybe you're a refier and the refi market's gone and you need to get to purchase? Where can I make an impact on purchase? And can I do USDA business in an area that I never did before? So you've been successful doing what you did. So see what you can do to continue that success, because your subservicer can do that for you. They can help you be successful because of the capacity that they have.
Excellent. Well, I want to thank you guys both again, Lori Pinto with Cenlar and Mike Wilkinson with Dovamil. Thank you very much for your time today. Appreciate it. Value partners. Love you guys sharing your expertise with the TMC family. Thank you all so much for being here today. We really appreciate your time. And please come back to TMC Connect. We've got lots of different conversations happening every day. So please check out our calendar and join us anytime you can. Thank you all so much. Stay safe, stay warm, and enjoy the rest of your week. Thanks, guys.
Thanks, everybody.
Thanks, everyone.